talk about the chart of accounts. Man, these are so important. They literally dictate like what your financial statements look like. Yet so often I see people getting this wrong. Their P&L is like 60 lines long and 8 accounts that all mean the same thing. For some reason, there's like a social security number in there. It's actually not that hard to structure your chart of accounts correctly. And once you do, you'll have a much smoother time understanding your financial statements. Here, let me walk you through 5 tips for how to structure your chart of accounts the right way. But first, go ahead and download this infographic right here on the chart of accounts, followed by this Excel file. Okay, so let's define what exactly is the chart of accounts. Here we have a profit and loss, and here we have a balance sheet. These accounts here, they're called general ledger accounts. And together, if we put them all in one list, they make up what is known as the chart of accounts. I'm in QuickBooks Online, and as you can see, I can now access these accounts and change them if I want. So your chart of accounts is pretty much a collection of the account names that display information in your financial statements. Now, you can get really crazy with your chart of accounts if you want. You can call a revenue account Tooth Fairy Income for money you make as a tooth fairy. Or you can call an expense account Hustling, if you're hustling. The struggle's real. Heck, you can even call an account if you really want to. There aren't many rules, but I wouldn't really suggest that you use any of these names in your chart of accounts because it may confuse the readers of the financial statements. See, your chart of accounts is designed to explain what exactly is happening in your business. By what is happening in your business, I mean via your profit and loss, which shows the performance of your business, and your balance sheet, which is like a snapshot that shows the position of your business. Now, these two statements are really popular. They're a very common way to explain what exactly is happening financially in your business. And those people that we said earlier who will read your financial statements, they're called the readers of the financial statements. So for public companies, they can literally be anyone since the information is public. But for private companies, that may only be a select group of people, such as the CEO or management. It could be investors or lenders. It could be the finance and accounting department, represent, or other department heads. The key is being able to explain what is happening financially in your business with just these statements. The more intuitive your chart of accounts is, the more the readers can understand what's happening, and the less will be pinged at 4 a.m. for an emergency meeting to discuss and explain what exactly all this means. Okay, so now let's go over 5 best practices or rules for structuring your chart of accounts correctly. Rule number 1, don't use vague account names. Instead, use descriptive accounts. Now, let's go over an example. Which account here is easier to understand with regards to what it represents? Rent and lease or other business expense? I'll give you a sec. Okay, I really hope that you chose rent and lease. Because the problem with other business expenses, you have no idea what it means. Is this a Christmas tree that you bought for the office or a trip to Antarctica for your company's retreat? Your guess is as good as mine. And that brings us to the next rule, rule number 2, which is the exact opposite of the first rule. Don't use redundant accounts. Instead, be concise. See, sometimes I see a chart of accounts that's way too descriptive. It'll say travel expense, and then below it, it'll also say train expense. And then below that, it'll say car expense. And then below that, taxi. And then below that, rollerblades. Okay, if you run a business where transportation is a huge factor and it's useful seeing this breakdown, go for it. Again, there aren't really any rules, but if you have like $5 in expenses for the entire year to an account called car expense, and then $10 for the year to another account called like van expense, just lump them all into an account like ground transportation or travel. The general idea is you should only create a new account if it has a material amount of transactions in it. Otherwise, combine the entries into another account. And that brings me to rule number 3. Don't include any personally identifiable information in your chart of accounts. This is another example that I see all the time. Employee names show up in the payroll section on the P&L, or investors' names show up in the debt section of the balance sheet. Why would you do that? Your financial statements can make its way to tons of different people. Do they really all need to know about these personal details? Just use an account that it represents, like for instance, payroll expense, or long-term debt, or preferred stock, or whatever. You can then keep track of all the details for who exactly goes into each of these accounts in your backup work papers in Excel. And now we get to rule number 4. But first, if you're still with me, how about giving this video a like? It's a free way to support this channel and it really makes a huge difference. Okay, back to rule number 4. Group relevant accounts together. You want the readers of the financial statements to not only understand what's happening, but to do so quickly. And a great way to do that is by adding sections in your financial statements. So if you have an account like accounting fees, legal fees, recruiting fees, why not group them into a section called professional fees? Or if you have wages and salaries, payroll taxes, health benefits, how about payroll fees as a section? Now you can see them all next to each other as well as the section totals. And speaking of grouping your accounts, let's talk about another important topic, that is ordering your chart of accounts with rule number 5, using numbering. Numbering is a great way to give a custom order to the accounts on your financial statements. Otherwise, the default in most accounting softwares is just to show that information alphabetically. But what's cool about numbering is they can also give context. For example, traditionally, all asset accounts are in the 1000s, all liability accounts in the 2000s, and all equity accounts are in the 3000s. For the income statement, all income accounts typically get shown in the 4000s, all cost of goods sold accounts in the 5000s, all operating expenses in the 6000s, then all other income in the 7000s, and all other expenses in the 8000s. And those are my 5 tips for structuring your chart of accounts correctly. But I can go on and on for hours with more suggestions about how to structure your chart of accounts. But now I want to hear from you. Tell me, what are some other suggestions to structuring your chart of accounts properly? Let us know in the comments below, and I'll catch you next time.